Welcome, everybody. I'm Jeff Taft. I'm a partner in Mayor Brown's Financial Services Regulatory and Enforcement Group. And today we welcome you to our SVB Signature Bank Response and Emerging Issues program. This is the first of several we're going to do this week, and we hope you can join us for those as well. I'm joined today by a number of my partners and colleagues, and I will introduce them as we go through the program today. A couple of quick housekeeping notes before we start. We want to note that the views of the panelists today are views on the current market and are not intended to be legal advice. In addition, if there are members of the press who are listening today, we remind you that matters discussed here today are not to be considered for publication or attribution without Mayor Brown or the panelists' express written consent. Members of the press should contact Stacy Berkowitz if you have questions or want to have follow-up questions answered by some of the panelists. If you have questions today during the program, please use the chat function and enter those questions. We will try to answer as many of those questions as we can today, but we'll also answer some of those possibly on Tuesday or on Wednesday during our other programs. Your name will remain anonymous. We will not attribute the questions to anybody, so do feel free to send in your questions, and we're going to answer them at the end to kind of keep the flow of the program going. So with that, I'm going to start with the timeline just to kind of have everybody level set. I suspect a lot of people do know the timeline, but I do want to go through it because I think it's important. It obviously will guide some of the conversation that we're going to have today. And it also will be instructive of how quickly things have been moving in this area and how quickly things can change in the course of the day or an hour or so. So let me start. I'll go back to Friday. Seems like a long time ago, but it really isn't all that long. So on Friday, I think this all started when the California Department of Financial Protection and Innovation took possession of SVB Bank. And in doing so, they appointed the FDIC as receiver. The FDIC's response to that on Friday was to create a depository institution national bank, what we generally refer to as a DIMB. The DIMB was set in place to protect the insured depositors of SVB, and all of the insured deposits of the depositors of SVB were transferred to the DIMB. So for most part of Saturday and the early part of Sunday, I think you and many others spent a lot of time talking about what this meant, what the potential implications and ramifications for the industry, for customers, for deposit holders, and others would be. Worrying about, obviously, people who had uninsured deposits, worrying about people with loans, whether they would be able to set off, whether SVB would end up being a defaulting lender in a number of its arrangements, whether it could be replaced as an agent, and all of those discussions went on through the weekend. Then late on Sunday afternoon, there was another development where the New York Department of Financial Services took possession of Signature Bank and appointed the FDIC as receiver of that bank. Around the same time, the FDIC established a bridge bank and transferred all deposits and substantially all the assets of Signature Bank into the Signature Bridge Bank. Same time, the FDIC, the Fed, and Treasury issued a statement that they were using their systemic risk exception to protect all of the depositors of SVB and Signature Bank. So not only were the insured depositors going to be protected, but all depositors got that protection, which obviously was a big change from how we were thinking about this situation on Friday and on Saturday. Simultaneously, the Fed also announced that it was making additional funds available to eligible depository institutions to help them meet the needs of depositors. This facility was called the Bank Term Funding Program, and would allow banks to basically borrow or advance against assets they had from the Federal Loan Bank, from the Federal Reserve banks. Those assets that they had could be pledged basically at par value, 100% of their par value, and they would get 100% of an advance against that collateral, which is a little different than the Fed's discount window and how that operates. So that was obviously done to shore up some of the concerns in the marketplace that other banks may be facing similar liquidity crises that were facing both SVB and Signature. So that was designed obviously So when the banks open today, they would have access to that, and the public would understand that there were those additional funds available to those banks. On Monday morning, we were greeted by the FDIC news that they had created a bridge bank for Silicon Valley Bank and transferred all of the deposits and substantially all of the assets to this bridge bank. Today, the bridge bank for Silicon Valley Bank and for Signature Bank are basically functioning and providing access to deposits and to customers. And customers are moving funds effectively out of those banks or moving them around as they see fit. With respect to the bridge banks, there are some things obviously we do not know. We don't know exactly what assets were moved from the bridge bank into the bridge banks from the banks that remain in receivership. Obviously, we know all the deposits were moved, but we don't know what assets were moved. We just know substantially all the assets were moved. One thing we also do know now is that the qualified financial contracts that were held by both SVB and Signature Bank have been moved from those banks into the bridge banks. The transfer of the QFCs is obviously an important step. The FDIC basically has until 5 p.m. of the following business day after it closes a bank to make those transfers of those QFCs. By making a transfer to the bridge banks, effectively the FDIC has limited the ability of counterparties to those qualified financial contracts to terminate those based upon the fact that the banks were placed into a receivership under any sort of an ipso facto clause in those QFCs. QFCs are generally derivatives, securities contracts, and other special contracts that receive both special protection under the Federal Deposit Insurance Act's receivership provisions, but also under the bankruptcy code as well. So I think that's kind of where we are right now. Obviously, folks are going to kind of get into a little bit more detail around that. But I think a good place to start right now would probably be on some of the things that are going on in Washington and how this is playing out in Washington and what the likely ramifications are, both from a political and from a regulatory standpoint. And to do that, I'd like to call on my colleague, Andrew Ullman, who's a partner here with me in the DC office, to kind of talk about this. So Andrew, I know you're out there, so take it away from me.
Sure, make sure I'm up here.
I can see you.
Perfect. Okay. So let me start with just some kind of high picture views of what's happened here. In many respects, the way the Silicon Valley Bank and Signature Bank have been handled is a kind of textbook bank resolution. You know, we all know bank runs happen. That's why you have the FDIC and the Fed. And under the statutory regime, the FDIC's role is to come in and resolve a failed institution, while the Federal Reserve's job is to provide liquidity to solvent institutions to help calm the run. And that's exactly what we've seen over the weekend. Is the FDIC is put in charge of resolving Silicon Valley Bank and now Signature, and the Fed has provided a broad-based liquidity program for depository institutions. The one unique feature, though, about this resolution is that the FDIC invoked what's known as the systemic risk exception to its resolution processes. Normally, the FDIC has to resolve an institution in a way that maximizes the revenues for the taxpayer. If they believe a systemic event is about to occur, it can, by a supermajority vote of both the FDIC's board and the Board of Governors, it can then, and also with the Treasury sign-off, invoke this systemic risk designation exception, and then provide additional assistance to the institution, which is what happened here. And they did it to provide effectively backstopping all of the deposits. As we've heard a lot over the weekend, deposits are only insured by the FDIC up to $250,000. One of the real concerns by the regulators in this case was that the non-insured deposits were going to run and were in the process of running, and that was sparking a broader run throughout the market and amongst other banks. You saw somewhat of a flight to the largest banks under the concern that, under the belief that those institutions have had implicit backing by the federal government. So you started to see a movement away from smaller institutions and deposits. the FDIC, the Fed, including the Treasury, all were concerned about the systemic impact of that, and so decided to back all deposits here. That move is likely to receive a lot of attention going forward by Congress, and we can talk more about this maybe in Q&A. There's a whole series of policy issues there about whether or not you want to have depositors monitoring and imposing market discipline on banks, or is it better simply to have deposit insurance for all deposits up to a much higher amount, since the market discipline may be very weak. Those are policy decisions that will be left to Congress, but are clearly ones that are going to be being discussed because of the way this resolution was handled. Another thing I'll just note here is that the Congress has already started a whole series of briefings on this. So we're likely to hear from those briefings even more details, exactly what happened in the supervisory process for Silicon Valley Bank. Representative McHenry, who chairs the House Financial Services Committee, has already indicated he's going to be doing a hearing. So we're going to hear a whole lot about bank supervision. And actually, this would be my kind of final point is, I think it's going to be very clear we're going to see bank supervisors calling all their institutions, double checking their liquidity and capital ratios and risk management processes, making sure they understand the extent of their any risks that they may have in their uninsured deposits. Silicon Valley Bank appears a little bit unique because of its high ratio of uninsured deposits. Most institutions have a much higher kind of traditional retail base of deposits that are pretty sticky than Silicon Valley Bank. So in some respects, it is an outlier, but you're very likely to see regulators now really nail down on institutions' depository base. And a lot of that information is likely to go back into how they recalibrate the kind of Basel endgame capital requirements that were set to be finalized this year. It's very likely some of the lessons that are learned as the examination of what happened here will be brought back into that debate later this year. So with that quick overview, I think I turn it over to Matt to talk about some of the more technical aspects of the lending facilities.
I think one thing
Yep.
get into, Andrew. I mean, I think one of the things we want to talk a little bit about is just what's likely to happen here. And I think that by the use of bridge banks, I think we're all expecting that the FDIC is going to obviously try to sell these institutions as going concerns effectively. And that was the purpose, I think, of setting up the bridge banks, kind of moving away from the DIMBY structure. So I think that's an important thing, that while there are bridge banks and people will be interacting with these bridge banks, I don't think we would expect the bridge banks to be anything more than a vehicle potentially for the sale of the going concerns. And the FDIC obviously maximizing that vehicle and maximizing the business in there and keeping it going as a going concern so they can obviously sell it off. And I think that's what we would expect. I mean, and Andrew, I think there were a lot of activities over the weekend around sales.
Yeah, and I think one of the other ways, another piece to go on the sale is one of the other reasons to invoke the systemic risk exception and guarantee deposits is it stabilizes the funding base for the institution. And it's very possible the FDIC did not like the bids that it received over the weekend. And by taking this action, it helps preserve the kind of franchise value of the institution and buys them a little bit more time to have an auction process that yields a better return for the taxpayer. The money that the FDIC will be advancing here to keep the institution running during there is money that effectively is backed by the taxpayer. The FDIC has a line of credit from the Treasury Department. However, it also has the authority to levy assessments for any losses that it may suffer here. Those assessments would be levied across the insured depository institutions. So there's both a systemic risk element of how they resolved this over the weekend, but also a tactical decision on how they run that auction.
Thanks, Andrew. I think now we're going to turn it over to Matteo, who's going to give us a little bit of the perspective from the ECBC perspective that he's been working on all weekend, obviously.
Yeah, thank you very much. Absolutely, it's been a very busy last 3 or 4 days, and we've seen a lot of activity, especially insofar as a lot of portfolio companies that had venture funding locked in with SVB. And we've published some materials over the last couple of days to answer all of the questions that our clients have been posing. And so I'm happy to share some of those questions now and sort of reframe the issues that have come up. And obviously, it's a fast-moving situation, very dynamic, so things are changing by the hour. But basically, I guess we can really put everything into like 3 buckets as far as the ECBC world is concerned. We're seeing issues as far as questions coming from our fund clients, primarily related to capital availability. In other words, funds that had their core deposits with SVB, and all of a sudden they were concerned they couldn't fund deals they had committed to close or finance in short order. And so, now the situation is changing, and we're understanding that those funds will be or are becoming available. But the concern on the fund side was one about capital availability. And then as a corollary to that, there were issues that came up, or questions that came up related to potential liability exposure for fund managers, and also, whether investors had the redemption rights in venture funds given a situation like this one. And so we posted a Q&A on our website addressing some of these questions, which are still valid, as general information pieces. As far as on the company side, we've seen the main issue has been capital availability for operations. Aside from deals that were uncertain whether they would close or not, many companies that had recently closed venture rounds or just had cash on their bank accounts all of a sudden faced a liquidity crunch, and so they had operational concerns. So one example is a solution we've seen has been emergency credit lines. A bunch of lenders out there have been very active and proactive in coming up with solutions and providing interim credit for companies, but also existing investors not affected by the liquidity crunch have been able to extend interim credit lines to startups. And also we published some of those forms on our website as well for the startup community at large to look at. And also as far as the deposits themselves, an issue that came up on Thursday when there were the first kind of rumors about this situation was whether founders could quickly move cash out of the company bank accounts into personal accounts sort of as a temporary solution, with of course with the consent of the investors and the appropriate governance appropriate measures. And so we're seeing founders essentially take temporary custody of company funds, of course with the idea that the funds would be returned under the company name when an account is open at a different financial institution. And so we have published the interim custody agreements, as well as the appropriate board consents and other documents on our resource center for companies facing this situation. So ultimately, it's a fast evolving dynamic here, and we're trying to be proactive to our client base, also taking advantage of the fact that our firm is really strong in financial institution work and banking work. And so this happens to be sort of the crossroads between ECBC and financial work. And so, we've been sharing as much information as we can in a timely basis, and we'll look forward to publishing more and more content for our ECBC communities.
Thank you, Matteo. Thank you. That's very, very great perspective from you. I think Scott Zemser, if you have a moment now, maybe talk a little bit about what's going on in the syndicated market.
All right, Jeff, thanks. All right, so I'm going to discuss a few things, and there's a lot to cover generally, but I'll cover the more of the LevFin, I-grade bilateral side and the syndicated loan side. And I already saw there's a bunch of questions that are coming in on defaulting lender concepts and how that kind of runs through. And it's, as most of you know that deal with these agreements, it's a rather complicated concept that runs through credit facilities, but defaulting lender concept was created in particular for circumstances like this, where you could have a lender that is either insolvent, a lender that can't fund for various reasons, or a lender, frankly, who gets taken over by the FDIC, and that's the situation we're in currently. I would say the lion's share of credit facilities, again, I-grade, LevFin, probably the clubby type deals have a concept on defaulting lender, and in this case, I would be very surprised. It's always possible that if there isn't a defaulting lender concept in most agreements, and it will get triggered by the FDIC or another governmental agency taking them over. So what does that all mean as a practical matter? Well, in most cases, if it wasn't the FDIC that was involved, you could kick that lender out. You could, if the lender is an agent, you could replace the lender with a required lender vote. You could yank that lender. There's a panoply of different ways to deal with that issue. The problem we have here is that the FDIC has, for lack of a better word, a 90-day standstill period where they can challenge many of these concepts. And that's still a discussion we're having internally and trying to get more guidance on as to how this is going to work. If there was a takeover and these loans went into a portfolio and a takeover, let's say by another lender and not the FDIC administrating this, that may be a different situation. But today we're grappling with this issue on what happens if SVB doesn't fund, and I'll just leave this discussion to SVB because they happen to agent a fair amount of facilities, and they're also a lender in facilities where they don't agent. How to deal with this if, in fact, the FDIC doesn't allow a yanking of them in certain cases, replacing them. It has implications for collateral accounts that are sitting with SVB, which is money for a syndicate of lenders or a borrower. So there's a lot of discussions we're still having. There's no clear answer as to how this is going to work without some further guidance. But our team is continuing to work on this. And the ramifications of not having that clarity create all sorts of uncertainty for the syndicated loan market. But unfortunately, we don't have the answer today as to how that's going to get dealt with. There's concepts going around now, I can tell you, of refinancings and taking out facilities with a pay down. The problem you have there is that if you do that, you run the risk of not having a payoff letter and a signature of the agent bank and releases and so on and so forth. It could be problematic, but it's certainly a discussion going on in the marketplace. Not perfect, but possible. Other than that, until we get that clarity, I think we're going to be trying to figure out different avenues to deal with this possible issue of having SVB not either funding or dealing with certain agency-related issues. So that's the defaulting lender concept. And I know there's some questions, and we'll deal with those toward the end. So Jeff, I'm going to bounce it back to you.
Thanks, Scott. Appreciate it. I think a lot of the discussion and all of our discussions today so far has really focused on both of the banks, Signature Bank and SVB. But obviously there are other entities within those holding company structures. And even though they may not be in the FDIC receivership, obviously there's implications of that receivership for those entities, including SVB UK, which is their UK branch, UK bank. So I'm going to turn it over to our colleague Debbie Shaw in the UK to give us a little bit of a briefing on what's going on over there and how that might have an impact.
Thanks very much, everyone. So SVB had a UK subsidiary, which was the UK authorised bank. It was a much smaller operation with a reported 3,000 odd customers. And as at the 10th of March, so last Friday, was reported to have loans of around £5.5 billion and deposits of around £6.7 billion. Its last accounts, it reported a profit before tax of £88 million. So that gives you a sense of the size. On Friday, the Bank of England, which is one of the key regulatory authorities here in the UK, had announced that unless some other solution was found, it would place SVB UK into a bank insolvency procedure today, Monday. But happily, a solution was found over the weekend. And so, as many of you would have seen, it was announced this morning that the Bank of England had taken the decision to transfer all of the shares in SVB UK to a private sector purchaser, HSBC UK Bank PLC. As a result, SVB UK will remain an authorised bank. It will continue to trade as usual. So some of the issues, many of the issues that we're going to be discussing today should not generally arise. Customers are instructed to continue to deal with their usual contacts and to continue to make loan repayments as normal, for example. So from our perspective, parties with any arrangements need to check their documentation to confirm whether SB UK was their counterparty on any of their dealings, because the position is going to be quite different if that's so. Just stepping back, the transfer of the shares was made pursuant to the Bank of England's statutory powers under the UK special resolution regime. This was also a regime that was introduced after the global financial crisis to enable the authorities to deal with failing banks. It's a mandatory transfer of the shares. They are transferred free from encumbrances and regardless of any restrictions on their transfer or holding. Just to be clear, the assets and liabilities of the parent company, so the US entities of SVB UK, are excluded from the transaction that took place here. And also importantly, particularly for those parties affected, the transfer of shares by the Bank of England was accompanied by the cancellation of SVB UK's capital instruments, being its AT1 instruments, so £322 million in perpetual notes that was issued by SVB UK, and Tier 2 instruments amounting to £33 million of subordinated debt. So the principal amount of both of these instruments was reduced to zero, and all liabilities of the UK bank in respect to these capital instruments, including to pay accrued interest, has been cancelled. So those are the key points as we stand here today.
Thanks, Debbie. That's very good to get that European perspective. As everybody knows, SVB and Signature Bank were owned by bank holding companies, or maybe people aren't aware of that. But so those bank holding companies obviously remain out there. Their main asset has been basically put into receivership. So one question that's arisen now is what will happen to the holding companies? I think Scott and Joaquin are going to talk a little bit about what we think the outcomes possibly may be there based on some of our prior experiences with holding companies and what we've seen happen in the market. Scott, Joaquin?
Sure. Thanks, Jeff. This is Sean Scott. I'm a partner in the global restructuring practice. And Obviously, much of our focus in the last 80 odd hours has been supporting our clients on these issues. Some of the issues that Scott highlighted for our lender clients in particular have a lot of overlap with bankruptcy code issues. As Jeff mentioned, while banks and savings associations and other depository institutions are not eligible to become debtors under the U.S. Bankruptcy Code, many of the relevant provisions of the Federal Deposit Insurance Act that apply to these types of institutions borrow from the U.S. Bankruptcy Code. So on some of these interpretive questions of first impression, including how to deal with defaulting lender provisions, for instance, we've been teaming with Jeff and Matt and Scott and many of our colleagues in the finance and the financial services regulatory and enforcement practice to try and provide a clear view. And I just wanted to highlight, for instance, as Scott talked about, in the bankruptcy world, there's the concept of the automatic stay. The FDIA does have not exactly coextensive, but similar provisions that provide that parties can't exercise powers to terminate, accelerate, or declare defaults under contracts with depository institutions, or to obtain possession or exercise control over property of the institution. And so, in the context of these discussions, we've been trying to determine and looking at specific contracts in particular, the rights of counterparties. In terms of bank holding companies, those are eligible to become debtors under the U.S. Bankruptcy Code. But I would say on that side, we are in a holding pattern, no pun intended. Interestingly enough, there continues to be market speculation, particularly with respect to SVB Financial Group, the holding company there, that it may be able to sell some of its other business segments, including its asset management arm, its private wealth, and its securities businesses. Within the past hour, SVB Financial Group disclosed on Form 8K that it had hired Alvarez and Marcel, which is a very well-known restructuring advisory firm, to serve as restructuring advisor. They've appointed a CRO to explore strategic alternatives for the company and for those businesses. What remains to be seen, however, is how those transactions will be effectuated, possibly through a Chapter 11 proceeding, potentially through a subsequent sale of assets under Section 363 of the Bankruptcy Code, or through a Chapter 11 plan. What I think is important to note today is, to the extent there is value at the holding company of these institutions for which the FDIC has appointed a receiver for the regulated bank, we can fully expect there will be priority disputes later between or among creditors of the bank, potentially the FDIC, and creditors and equity holders at the holding company. So certainly more to come on that, but my partner, Joaquin Cidabaca, will give us some insights on some lessons learned from the past financial crisis and possibly some issues that could come into play.
Just one quick point. I apologize for jumping in, guys, but I did, as I was teeing up the question, I did misspeak, because SVB does have a holding company, but Signature Bank is not a bank. It is a bank without a holding company, which is somewhat unusual, but so it's a different scenario. And I think that probably explains, Sean, why you're only hearing about SVB's holding company. So I apologize. I was teeing up the question a little broad based.
Yep. No, great point. Thanks, Jeff.
Yeah, and picking up where Sean left off, and also referring to SVB Financial Group specifically, as Sean just alluded to, the Chapter 11 cases of bank holding companies are classically pretty messy cases, and Sean alluded to some of the battles we saw in 2008 and at other times. One of the stronger and more remarkable powers that a debtor has in a Chapter 11 case is the ability to assume, reject, or assume and assign its executory contracts, its unperformed contracts, and its unperformed leases. And so you all may be familiar with that concept generally. That typical rule doesn't apply in bank holding company cases. And in fact, it's sort of the reverse. To the extent that a bank holding company has got a commitment to maintain commitments to the bank, it is compelled under Section 365(o) to assume those contracts and to fund. And so one of the things we have seen in prior bank holding company bankruptcies is a tremendous amount of litigation over whether or not those commitments do in fact exist. The statute doesn't really specify, what counts as a commitment in that regard. So, you get into a lot of nitty gritty examining whether there's a written commitment, whether oral commitments have been made. And to Sean's point, to the extent that, it's not readily apparent that that all parties are meeting their commitments, or if the FDIC feels as though SVB Financial Group should be paying down into the bank holding company, you could see some pretty messy fights breaking out in that regard. It's along those same lines, we would ask ourselves if there are any other types of commitments that might be implicated in a bank holding company bankruptcy, such as tax sharing agreements. And then just generally speaking, I think we all remember the various long length of those cases around the time of the last financial crisis. With that, I would turn it back over to Jeff.
Thanks, guys. I appreciate you covering off on that. Let me turn it over now to Megan Webster, who's going to talk a little bit about crisis management and having a playbook in place and some of the things that we can kind of maybe glean from this experience after a few days. Megan?
Thanks, Jeff. I think one of the things that we've all learned, and certainly most of the participants on the phone will recognize, is the need to have a playbook in place to help navigate these issues, not certainly just a failed bank issue, but emergencies and issues that could face an entity. That generally includes the need to assemble a nimble internal team and external team of trusted advisors. And depending on what the event is that impacts your organization, these playbooks potentially include board insecurities disclosures, evaluations of potential risks and plans to mitigate those risks. They also include internal and external communications plans. I think we've seen a lot of communication that was rolled out and rolled back, and certainly the need to have counsel to be involved to protect privilege where possible is key. One of the things that really changed overnight, literally from Friday to Saturday to Sunday, is whether or not people would have access to funds. So having a nimble team in place at the executive level and at the general counsel level is really helpful. Jeff, I think you and many of the others on our panel here, we've seen the need to review treasury management plans of our clients and of our colleagues across industries to make sure that they understand and plan for risks. Those entities that banked exclusively with a single institution were really scrambling sometimes to look for lines of credit and other remedies before the news on Sunday regarding access to funds broke. So having in place access to bankers and other items and resources at your entity's fingertips really comes into play. We've been fortunate to work with our clients on these aspects and helping out not just financial institutions, but everybody across the board with their risk management plans and other requirements. And you heard Andrew talk a bit about what we can expect the government to do in terms of heightened regulation and other areas. Jeff, over to you so we can leave some additional time for questions. And thanks to everybody who's typing in questions. We'll get to those shortly.
Thanks, Megan. I think we can start to go through some of the questions now. I think there were a number of questions in the queue, so
Sure.
Maybe open them up and let folks on the panel kind of address them.
Sure. I think just in terms of some housekeeping, we've gotten a couple of questions. We have planned, as Jeff said at the outset, that we're going to have some additional webcasts over the next few days. And we will be sending out invitations with times for the next program. In addition, there will be a replay of this presentation, and it will be on the website shortly after the program concludes. And then we'll also be distributing the recording link to the registrants. Jeff, a more tactical question. Can you explain why the receivership certificates issue is no longer in play and what they were, just for those who haven't been following it? We've gotten a couple questions on that.
Yeah, it's interesting. So typically when a bank fails, there are going to be depositors who are uninsured. Those depositors obviously don't get the benefit of having they get the benefit of the $250,000 of deposit insurance. But anything above that limit, they are effectively an unsecured creditor. Now, under the Federal Deposit Insurance Act, which basically regulates the liquidation and resolution of insured depository institutions, depositors have a general preference over other unsecured creditors. So oftentimes, even though you may have uninsured deposits, you may get effectively what is an IOU or a certificate from the FDIC that represents some interest initially in what they estimate will be your recovery from the sale of the bank's assets. And those receivership certificates were things that obviously the FDIC was contemplating providing on Friday and had discussed distributing those earlier this week. Now, the need for those receivership certificates went away when they decided yesterday that they would cover, as Andrew said, through the systemic exemption, they would cover all depositors. So there was no need to deliver these certificates to people. So that concept went away. It's been out there for other resolutions, and undoubtedly it'll come back in the future when other banks fail, but the concept really doesn't have any other value or merit here because there's going to be a full payout of all the depositors, and they're not going to be waiting upon the resolution and liquidation of the bank in order to receive their funds.
Thanks, Jeff. I think another question that we've seen come up over and over again is in cases like SVB. And is it mandatory that banks honor all of their contracts, including credit card agreements or credit agreements, depository agreements, loan agreements with the borrowers? Can we talk a bit about what that process is once the FDIC comes?
Yeah, so I can start off and others can obviously weigh in. When a bank fails, the FDIC as receiver has a number of powers, and they have what we generally refer to as superpowers, not in the Superman or Spider-Man sense, but in the ability to basically repudiate or reject any contract that's burdensome with respect to the resolution of the institution. In the eyes of the FDIC, just about every contract is burdensome, so they have the ability to repudiate those contracts as receiver. And when they repudiate the contracts, people are entitled to basically actual compensatory damages. So you can't get punitives or things of that nature. But of course, those damages are all against the failed institution. So in many of those cases, you're an unsecured creditor and your claims aren't going to be worth a particular lot. So that gives the FDIC a lot of authority and a lot of power with respect to those contracts. I suspect there were a number of contracts that the FDIC had left in the original banks that may not have moved over to the bridge bank because they have every intention of repudiating those contracts. They may not be loan contracts. They could be service contracts. They could be other types of contracts like that that may not be necessary for the operation of the institution. But they could certainly provide notice in the coming days to people that those contracts have been repudiated. And the FDIC obviously has the ability to not perform on the contracts. And again, there's an automatic stay period, as folks have mentioned, for 90 days. So those two, kind of elements are out there, and the FDIC can choose, not to fund on agreements and not to pay out requests for advances or draws on facilities. I think in the case of, Signature Bank, which is the bridge bank now, they have indicated every opportunity that they are in full business and they're willing to extend and do all the things necessary. I think from the FDIC's perspective, that's obviously being done to maximize the value of the going concern so that when they go and sell this institution, they'll get maximum value because everything will be performing and they'll have loans and all of that can be transferred to a buyer. So I would think for the most part that to the extent those contracts are in the bridge bank, they're basically going to be performed by the institution and they hopefully will be transferred. Now, if the buyer institution doesn't want them, they may find themselves back in the receivership and being terminated. So that certainly could be something that happens down the road. Let me just open it up if there are others, obviously, who want to weigh in on that.
Yeah, Jeff, it's Sean. I would add to that there is a bit of asymmetry there, which I think Jeff highlighted. you have the FDIC able to repudiate the contracts at any time. And meanwhile, as we highlighted earlier, you have this 90-day period where counterparties can't declare defaults, can't affect contractual rights without, and there's two exceptions there. One is there's, exceptions potentially for qualified financial contracts, although as we've seen there, those are being transferred to a bridge bank. So there may be an exception to that exception. But the other point that we'd highlight is on that stay, it's without the consent of the receiver as appropriate. So you do have this 90-day period, but I do expect there will be some clarity, as Jeff highlighted, over time as to whether commitments, loans are being transferred through the bridge bank to a new potential owner, or whether those contracts are going to be repudiated. I think the message there is be very careful about your contracts, consult with us, but also this is not necessarily a time to move quickly, particularly on issues that may be more in that gray area. So I think Jeff, highlighted that ability to repudiate. I just wanted to focus again on, on the flip side, we are, if you're a counterparty to the receiver, you may be in a holding pattern.
Jeff, I think we're getting a bunch of questions about letters of credit.
I think our view on the letters of credit has kind of changed as the bridge banks have been set up. Typically, we had expected that the FDIC might repudiate those letters of credit, to get out from under that obligation. Obviously, as a going concern, it's more likely that I think those bridge banks who now have the deposits and now may very well have those letters of credit may continue to perform or continue to have those obligations out there. It's not as clear. We assume they transferred. We obviously don't know. They could have been part of substantially all of the assets. But that's something obviously that we're watching. We have a number of clients, insurance companies and others who are specifically been asking about that question. So I think that's something we're keeping open and something that we're following. But again, until we hear otherwise, I think we're going to assume that the banks are going to continue to perform or stand behind those.
I think that we just got a couple of questions clarifying whether or not the bridge bank will continue funding all loans. So Jeff, can you sort of walk back to what we were talking about with regard to both of the entities that we're talking about here?
Yeah, I mean, again, to the extent the loans were transferred to the bridge bank, I think we would expect that the bridge banks would continue to participate in those loans. Now, like any lender, they have the ability to not continue to participate, to not make advances. And Sean, I'm sure that happens in the real world all the time, from time to time, for various reasons. So, I mean, maybe that's worth talking about. But again, we expect they will. Signature Bank has indicated they will. They've indicated they're open for business, and we don't have any reason to believe otherwise. So, but again, everybody's got to make a decision with respect to every advance and whether they want to make that or not. Sean?
Yeah, no, I think just to echo that, there's expectation and then there's the legal obligation. I think right now, as Jeff said, even with the bridge bank in place, there's the ability to disaffirm any obligation to fund going forward. We've heard business as usual, but if you look at the FDIC statement, even on the bridge bank established this morning on SVB, it was clear that it said loan counterparties should continue to make payments. It did not have a unequivocal statement that they're going to continue to honor all funding commitments. So I think the long and short of it is there is no certainty that they will continue funding all loans. We're going to keep track over the next several days of what happens, and to the extent there is a going concern transaction of some sort, that's likely to mean that a substantial portion of those loan commitments will be funded. On the other hand, if they are uneconomic, as Jeff said, some may be left with the receivership estate and not funded. So it's going to be, I think, case by case. And while we can talk about the macro picture, any specific loan is going to be dependent on the circumstances of that facility.
And I think some part of the confusion obviously is because at one point during the weekend, the FDIC had indicated with respect to SVB that they would not fund any loans. They would not continue to to allow draws on the loans. And then all of a sudden they set up a bridge bank on Monday morning at 6 a.m. basically and said open for business. So I think that's part of the confusion and part of the fact that, it just shows that things change pretty quickly.
Yeah, and I think to Andrew's point early in the discussion, there was an attempt to auction substantially all of the book yesterday from what we understand, and now maybe things are being put out to bid. And now that the Fed has injected, some certainty into the situation, or at least, potentially set some comfort in the market, I think there's a hope that, that there will be potentially willing and able buyers out there willing to transact and essentially preserve the enterprise.
So we have a Dodd-Frank question that several people, maybe we'll direct this one towards Andrew. But in 2018, the question is a regulatory change that we all know about that impacted Dodd-Frank determined that banks with assets under 250 billion were not systematically important. In regards to SVP, they want to know, how did this impact regulatory oversight? The current assumption is that bank regulators would have been aware of the floundering balance sheets. Can you give us any what you would think, Andrew? Some of your insights on that?
Congress is going to take a careful look at this failure and determine exactly what happened here. But based on the facts that we've seen so far, there's no basis to conclude that. I suspect you're going to see a lot of kind of use of this failure for partisan reasons. But what that bill did was it changed the application of some enhanced prudential standards. First, it's important to note the enhanced prudential standards that are kind of issued here would never have applied either way to Signature Bank, because Signature Bank didn't have a holding company, and that was always outside the realm. Silicon Valley Bank was a institution that was on the smaller end here, and the types of regulations that the bill was seeking to tailor was to avoid having the same type of prudential stress tests and other enhanced prudential measures that are designed for the largest, $2-3 trillion banks applied to institutions that are, say, 50 billion. The idea was to right size it, so you have regulation focused on the exact risks that an institution presents, as opposed to risks having a one size fit all. Classic example, the vast majority of the smaller banks do not have, none of them have major broker dealer operations, and hence they have a very different balance sheet than the largest institutions. And similarly, all of their assets typically are in the bank, as opposed to generally the larger institutions have much more complicated organizational structures. So I think the real issue here, and I think former Governor Tarullo has already kind of pointed this out, is Silicon Valley Bank had its assets grew pretty quickly over the last year or so. And that's usually, from a supervisory standpoint, a flag. And they also had a very high ratio of uninsured deposits. I think most of us were pretty surprised at how high that ratio was. I think it was close to 90% of total assets. Don't hold me to the exact number, but it's very high. Those are usually more supervisory issues that the supervisor in charge typically would catch and focus on. But it's, again, my experience, having been through a few of these crises before, is we'll wait and see. Congress will do an examination. We'll get to the bottom and understand what exactly happened and why the regulators made their choices and how they resolved this. But I don't see how the bill is 2155 S2155 had any impact here.
Thanks,
One quick related kind of follow-up question, Andrew. Just there's a couple of folks who have asked, is it true that there's really no taxpayer bailout of the banks? And maybe explain how that really technically works. I mean, right pocket, left pocket, however you want to explain it.
Yeah, that's so. That's right. The FDIC, if it incurs a loss here, and when it sells the bank, then if it's advanced more money to help resolve it than it receives when it sells it, there'll be a shortfall. The FDIC will cover that out of the deposit insurance fund, but to recoup those losses, the FDIC will then turn around and levy assessments on insured depositories. Now, so that's not a direct taxpayer payment. Typically when you think about it, direct taxpayer payment, it would be Congress does an appropriation and sends that money to the FDIC. Now, however, the assessments once levied on banks, as we all know, everything kind of flows down to depositors, borrowers, and shareholders ultimately. And so the costs are kind of borne by larger society through that way. So as Jeff kind of points out, there's kind of no free lunch. Somebody will end up having to pay for this, whether it's through a direct appropriation or indirectly. That will be the case. It's not clear right now we're going to have a loss in that situation or the amount, but that's the mechanism in which the FDIC would be made whole.
Thanks. So in the few minutes that we have left, Jeff, do you want to spend some time talking about defaulting lender?
Yeah, I mean, I think Scott kind of covered off on that a little bit, in his discussions. And I think, we'll have to see what happens. I mean, again, it was pretty clear, I think, over the weekend that Silicon Valley Bank was going to be a defaulting lender. The question then became whether you could exercise that remedy against them under the automatic stay provision. So I think we're going to have to see how that plays out, as Scott said. I think there's some unknowns, first of all, as to whether, in fact, people are going to be a defaulting lender, and then whether the stay may come into play around that. So I think that's, something, and we can talk about that on Tuesday or Wednesday's call, I think, because that's something that's going to play itself out as people request draws and those draws aren't being made and things like that. I realize we're getting also close to the bottom of the hour here at 6:30. So I do want to be mindful of people's time, people's commitments, dinner, other things, family. So while this is riveting, I'm sure other folks have things to do. So let me just conclude by mentioning two things. One, we are going to have another program on Tuesday, another program on Wednesday, and depending upon developments, may subsequently have other programs. Second, we put together a resource page on our website. There's an ability to access certain information. Some of that information obviously is what's been put out by the regulators, but here's a comprehensive place to kind of get a hold of it. We'll post a link to this program there and the subsequent programs there as well. So if you want to check back on the website, there's going to be information there and information that may be helpful as you kind of navigate the situation. With that said, I want to thank all of my colleagues for participating. It's been, I think, hopefully a very illuminating discussion for people. And as I said, if we couldn't get through all the questions today, which I know we couldn't because we had 30 or 40 of them, we'll try to answer them in the upcoming programs. But in the meantime, everybody, thank you very much.
Thank you.
Thank you all.
Good night.